Part 1. The Origins of Power. The story of Goldman Sachs is not just the story of a company. It is the story of influence, of access, of the subtle, quiet power that shapes the world from behind closed doors. Today, when we hear the name Goldman Sachs, we think of global finance, high stakes, billions in motion, the invisible hands guiding economies, governments, and entire nations. But its beginnings were far humbler. A single immigrant stepping ashore in a new world, carrying more hope than money, more ambition than certainty. The story starts in 1848. Chapter 1. Arrival. The mid-19th century was a time of transformation. Steamships crossed the Atlantic, cities expanded, and the young United States pulsed with opportunity. Millions arrived looking for a new beginning. Among them was Marcus Goldman, born in Bavaria in 1821. A shoemaker's son, not a man of privilege, yet he possessed something rarer. He had the instinct to understand trust, to read people, to sense where value truly lived. When Marcus arrived in New York, he was not yet a banker. He worked first as a peddler, then as a small shop owner. But he watched the city carefully. He saw businesses rise and fall, and he recognized something essential. Opportunity was not in the goods that merchants sold. It was in the credit that allowed them to sell it. At that time, small businesses struggled with a simple problem: cash flow. They needed money to buy inventory, pay workers, and keep their lights on. But banks were reluctant to lend to ordinary merchants. Risk was high, trust was uncertain. Marcus Goldman saw this gap, and in that gap, he saw his future. Chapter 2. The Simple Idea. In 1869, he opened a small office at 30 Pine Street in New York City. Not a towering bank, not a marble fortress, just a desk, a ledger, a telephone, and one powerful idea. He would buy merchants short-term IOUs, called commercial paper, at a discount. Then he would sell them to larger banks for a small profit. It was simple, but revolutionary. Merchants received liquidity, banks received reliable returns, and Marcus Goldman became the trusted middleman. Trust, as it would turn out, would be the most valuable asset Goldman Sachs ever traded. Marcus understood the psychology of commerce better than most economists of the era. He knew that money moves fastest where trust is strongest. He cultivated relationships with discretion, reliability, and quiet efficiency. By the 1870s, his reputation had spread. He handled tens of thousands of dollars in transactions each month, significant sums in the era of horse-drawn carriages and handwritten ledgers. Yet the most important transformation began not in the books, but in the family. Chapter 3. The House of Goldman and Sachs. In 1882, Marcus invited his son-in-law Samuel Sachs to join the business. This was more than partnership, it was legacy formation. Samuel Sachs brought both financial insight and strategic vision, and soon, his influence became unmistakable. With the addition of Marcus's son Henry Goldman in 1885, the enterprise took its most enduring name, Goldman, Sachs and Company. It was not merely a business, it was a family network, bound by loyalty, discipline, and long-term thinking. While many firms chased quick profit, Goldman Sachs played the long game. Their true currency was access to information, to relationships, to decision-makers. And that access was about to reshape Wall Street. Chapter 4. A New Kind of Bank. By the early 20th century, America was changing. Railroads stretched across the continent. Steel, oil, and electricity forged the industrial age. Small businesses grew into giant corporations, and giants needed capital on a scale traditional banks could not provide. Goldman Sachs recognized that the future of finance was not mere lending. The future was investment banking, raising money not by lending it, but by selling ownership of companies to the public. 1906, Goldman Sachs helped take the United Cigar Manufacturers Company public. It was a success. But the real breakthrough came later that year, when Goldman Sachs was asked to manage one of the largest industrial public offerings ever attempted, Sears, Roebuck and Company. Sears was the Amazon of its era, an empire powered by catalogs, supply chains, and national distribution. It was a company that spoke to the masses. Goldman Sachs made Sears accessible to everyday investors. And just like that, Wall Street discovered something new. The American public wasn't just a consumer base. It was a source of capital. The modern stock market as we know it today, where ordinary citizens invest in corporate growth, was now fully awakened. Goldman Sachs had stepped onto the main stage of economic history. Chapter 5: The Power of Relationships. But success brought something else: influence. Henry Goldman and Samuel Sachs were not simply financiers. They became confidants to industrial titans. They advised CEOs, shaped expansions, and sometimes acted as mediators between competing empires. Their access to private conversations gave them insight that no economic report could match. Information flowed into their offices like a river, whispered, implied, or quietly suggested over private lunches and exclusive club gatherings. Goldman Sachs did not need to manipulate markets. They understood them before others even saw the direction of the wind. It was not brute power, it was subtle power, whispered power, the kind that moves nations not with force, but with persuasion. But as the firm rose, so did the risks. Chapter 6: The Dance with Risk. In the 1920s, America entered what became known as the Roaring Twenties. Stock prices soared, credit expanded, optimism was everywhere, and speculation began to replace investment. Goldman Sachs saw opportunity, but also danger. Yet in 1928, the firm did something uncharacteristically bold. It created the Goldman Sachs Trading Corporation, an investment trust that bought and sold stocks on behalf of investors. The trust was aggressively marketed. It grew rapidly, too rapidly. This was the era of leverage, borrowing money to magnify bets. Confidence created momentum, and momentum created blindness. For the first time, Goldman Sachs was no longer the careful, measured steward of capital. It was a participant in the frenzy, and the frenzy had a breaking point. Chapter 7: The Crash. On October 29, 1929, everything changed. The stock market collapsed. The bubble ruptured. Fortunes evaporated overnight. The Goldman Sachs Trading Corporation lost nearly all its value. Reputation, once the firm's greatest strength, now became its greatest vulnerability. Newspapers criticized the company. Politicians accused the firm of reckless speculation. A legacy built over half a century was shaken. But Goldman Sachs did not fall. It adapted. It retreated from speculation. It rebuilt slowly, choosing discipline over ambition. The lesson was clear: power without restraint is self-destructive. Goldman Sachs would never forget it. Chapter 8: The Next Generation. As the 1930s unfolded, regulatory reforms reshaped the financial world. The Glass-Steagall Act separated commercial banking from investment banking, drawing boundaries that would last decades. For some firms, the new regulatory environment was suffocating. But Goldman Sachs understood something profound. When the rules change, strategy must change with them. Relationships were still the firm's greatest asset, and during the Great Depression, businesses still needed guidance, perhaps now more than ever. Goldman Sachs shifted its focus from trading to advising. It became the quiet counselor once again, strategic, disciplined, deliberate. The firm did not chase the spotlight. It rebuilt trust quietly, one relationship at a time. And as war clouds gathered over Europe in the late 1930s, Goldman Sachs stood ready for a new chapter. One where finance would merge with government. One where economic power would become geopolitical power. One where influence would extend far beyond Wall Street. Part 2: The Age of Global Influence. The world was changing, faster, larger, more interdependent than ever before. As the 1930s closed and the 1940s began, nations were no longer isolated economies. They were gears in a vast global machine, one about to be tested by war. Goldman Sachs stood at a crossroads. The firm had survived the crash of 1929, but survival was not enough. Reputation had to be rebuilt. Purpose had to be redefined. The next chapter of Goldman Sachs would not be driven by speculation. It would be forged in the crucible of global conflict. Chapter 9. Finance in a World at War. When World War II erupted in 1939, markets panicked, then reorganized. Governments required capital on a scale the world had never witnessed. Economies shifted into wartime production. Steel mills expanded. Shipyards multiplied. Factories retooled. Money was the bloodstream of war, and someone had to keep it flowing. Goldman Sachs, like many American financial institutions, became a silent partner in the mobilization of industry, not directly building tanks or planes, but ensuring the companies that did could raise the capital to operate. This role was discreet, quiet, but essential. The war reshaped the global financial order. Old empires fractured, currencies destabilized, trade routes rerouted, and in the midst of all this, a remarkable shift occurred. The center of global finance moved. London, long the heart of the financial world, was weakened by war. New York rose. Goldman Sachs was not the largest bank on Wall Street, not yet, but it was uniquely positioned to benefit from a world hungry for reconstruction. War had destroyed infrastructure across Europe. Bridges, rail networks, energy grids, entire urban centers lay in ruin. To rebuild, nations needed capital. To provide capital, they needed trusted intermediaries. Goldman Sachs had spent decades cultivating trust. This moment was its opening. Chapter 10. Rebuilding Nations. The post-war period was defined by two forces: reconstruction and rivalry. Europe needed rebuilding. The United States had the industrial might and financial resources to lead that effort, and the Soviet Union had emerged as a new geopolitical power, creating a world divided between competing ideologies. The Marshall Plan, America's massive economic aid initiative, reshaped global markets. Industries revived, trade resumed, currencies stabilized. A new financial architecture emerged: the International Monetary Fund, the World Bank, the GATT trade systems, and the US dollar as the dominant currency of global exchange. This was not merely economics, it was geopolitical strategy. Goldman Sachs operated in this world not as a public institution, but as a private influence. The firm advised companies seeking to expand abroad, guided governments on debt, connected capital with opportunity. Goldman Sachs quietly helped American corporations become global corporations. Companies that had once served domestic markets now spread across oceans. Oil companies, manufacturing conglomerates, consumer brands. The American economy no longer ended at the American border, and neither did Goldman Sachs. Chapter 11. Culture of the Inside. By the 1950s and 1960s, Goldman Sachs had developed a reputation unlike any other Wall Street firm. It was selective, exclusive, insular. Working at Goldman Sachs was not merely employment, it was initiation. The firm valued discretion above publicity, stability over sensationalism, relationships over transactions. There was an unspoken code: do not boast, do not appear, operate quietly, let results speak. This created something powerful: the Goldman Sachs mystique. Partners were not hired for charisma or flamboyance. They were chosen for judgment, discipline, unwavering calm in uncertainty. The firm had no need for advertisements, no marketing campaigns. Its greatest marketing was its reputation, and that reputation attracted clients who valued subtlety: chief executive officers, political advisors, family dynasties, old wealth, new wealth. Goldman Sachs had become the banker's banker, the advisor to the powerful, but as markets evolved, new types of power emerged. Markets were becoming faster, more complex, less predictable. A new financial era was coming, and Goldman Sachs would help shape it. Chapter 12: A New Kind of Wall Street. In the 1970s, the global financial system faced turbulence. The United States abandoned the gold standard in 1971. Oil shocks disrupted global supply chains. Inflation surged. Recession returned. Old models failed. The world needed new financial instruments, tools to manage risk, hedge volatility, and move capital more fluidly. And here, Goldman Sachs played a transformative role. In the late 1970s and early 1980s, the firm began expanding into trading and financial innovation. Bonds, currency markets, derivatives, negotiated underwriting, asset securitization. Finance was no longer just about raising capital. It was about managing uncertainty. In 1981, Goldman Sachs purchased J. Aron & Company, a commodities trading firm. This acquisition marked the beginning of Goldman's transformation from a traditional investment bank into a hybrid investment bank plus trading powerhouse. Risk was now a product. Predictable outcomes were replaced by probabilistic bets, and Goldman Sachs was extremely skilled at calculating probabilities. The firm's new identity was forged in data, in analysis, in complex financial modeling. The quiet counselors of the early 20th century were now becoming the architects of modern financial engineering. The stakes had risen. Chapter 13: The Cult of Excellence. Goldman's internal culture evolved with its expanding ambition. Recruitment became ruthlessly selective. Only the top graduates, often the top 1% of the top 1%, were considered. Not simply intelligent, but relentless. Unshakable, able to work under pressure, measured not in hours, but in weeks and months of sustained intensity. Goldman Sachs became known for its training programs, environments that tested endurance as much as intellect. The goal was not merely to produce bankers, it was to produce strategic operators. The firm demanded total commitment, long hours, constant awareness, absolute loyalty. This culture created excellence and controversy. Critics argued the firm favored a worldview driven by efficiency and cold rationality, where profits and outcomes were valued above all else. Supporters argued the firm represented the pinnacle of meritocracy, where results, not lineage or social position, determined success. But one thing was undeniable: the Goldman Sachs partner was viewed not simply as a business person, but as a figure of influence, a person whose advice could move markets, redirect strategies, shape nations, and soon, that influence would flow directly into government. Chapter 14: The Revolving Door. Beginning in the 1980s, a pattern emerged. Executives from Goldman Sachs began entering high-ranking positions in government, not simply as advisors, but as national economic leaders. Robert Rubin, former co-chairman of Goldman Sachs, became U.S. Treasury Secretary. Henry Paulson, another former CEO, also later became Treasury Secretary. Mario Draghi, former Goldman Managing Director, became President of the European Central Bank. Mark Carney, former Goldman executive, became Governor of the Bank of England and the Bank of Canada. And other Goldman alumni served in roles across the IMF, the World Bank, and central banks worldwide. This was not conspiracy, nor coincidence. It was strategy. Goldman Sachs did not simply understand markets, it understood power. The relationship between markets and governments is symbiotic. Markets influence policy. Policy influences markets. By placing individuals who understood both worlds at the highest levels of governance, Goldman Sachs reinforced its role as a quiet architect of the global financial system. This sparked praise and suspicion. To some, Goldman Sachs became known as the Government Sachs, a firm whose alumni shaped policy frameworks affecting global finance. The line between public interest and private influence grew increasingly blurred. But this influence brought risk, and the world was heading toward a reckoning. Chapter 15. The Dawn of Deregulation. The final decades of the 20th century brought a powerful ideological shift. Governments across the US and Europe began reducing financial regulation. Markets were opened, boundaries loosened, risk-taking expanded. This period was defined by belief in efficiency, free markets, and self-regulating systems. In 1999, the Glass-Steagall Act, the law separating commercial and investment banking, was repealed. Financial institutions could now merge, trade, lend, invest, speculate, under one roof. This was the moment Goldman Sachs had been waiting for. It allowed the firm to expand aggressively across trading, asset management, private equity, and global investment operations. The world was now a financial marketplace with fewer fences. Innovation exploded. Credit derivatives, mortgage-backed securities, collateralized debt obligations. The new financial era promised unprecedented growth. But behind the promise, a storm was gathering, and Goldman Sachs was positioned at the heart of it. Part 3. The Crisis, the Controversy, and the Legacy. The end of the 20th century brought prosperity. Markets rose, credit expanded, home ownership soared. The global economy appeared stable, efficient, and secure. But prosperity can create blindness. And in the early 2000s, a silent construction was taking place beneath the surface, a structure built not of steel or stone, but of debt. It was intricate, layered, complex, and fragile. Goldman Sachs was not alone in building it, but no firm understood its architecture more deeply. The era of structured finance had arrived. Chapter 16. The rise of the housing machine. Mortgage-backed securities had existed for decades. The idea seemed simple. Bundle thousands of home loans together, convert them into bonds, sell them to investors seeking stable income. It was billed as safe, predictable, mathematically secure. But as capital poured into the mortgage market, banks needed more loans to satisfy demand. Congressional hearings, Senate inquiries, regulatory reviews. Goldman Sachs became a central figure in the public debate about financial responsibility. Accusations emerged that Goldman Sachs profited from securities it believed would fail, that it had too much influence in government, that it played both sides of financial transactions. Goldman Sachs defended itself. It argued that its actions were legal, rational, and transparent to sophisticated investors. The public narrative, however, was less forgiving. The firm paid billions in fines and settlements, but fines could not erase perception. Goldman Sachs had become, in the eyes of many, a symbol of systemic imbalance. Power that was too large, access too deep, risk too abstract, reward too concentrated. Its influence was undeniable, its responsibility harder to define. But the world was changing again, because a new era of finance had begun. Chapter 20. The Age of Invisible Capital. After 2008, markets did not contract permanently. They transformed. The center of global finance shifted once more, from banks to asset managers, private equity firms, sovereign wealth funds, and global capital networks. Capital was no longer controlled by institutions alone. It was diffuse, rapid, mobile. And Goldman Sachs adapted. The firm expanded beyond investment banking, wealth management, asset management, global advisory services, technology-driven trading, private equity networks, influence in Asia and the Middle East. It leaned into data, automation, algorithmic trading, machine learning models that predicted risk faster than human analysis ever could. The face of the firm changed, not the loud power of the trading floor, but the quiet power of the capital allocator. Goldman Sachs evolved into a global capital architecture, an interconnected web of influence across corporations, governments, and investment flows. The firm no longer simply shaped markets. It shaped the pathways through which global capital moves. Chapter 21. The paradox of power. Goldman Sachs is not universally admired, nor universally condemned. It occupies a paradox. It advises governments attempting to stabilize markets. It advises corporations seeking to maximize profit. It navigates between public need and private ambition. Its alumni write financial regulation. Its traders operate within that regulation. Its analysts predict outcomes influenced by those regulations. This is not conspiracy, it is design. A design built over 150 years. The cultivation of trust, relationships, discretion, access. The ability to understand not only how markets move, but why they move. To understand where power resides and where it is shifting. Goldman Sachs does not control the world, but it operates at the intersection of forces that do. And that is where influence lives. Not in force, in proximity. Not in commands, in conversations. Not in domination, in guidance. Power that does not need to be seen to be felt. Chapter 22. The Legacy. The story of Goldman Sachs is the story of modern finance, a story of ambition, risk, reinvention, consequence. From a single immigrant peddler with a ledger book, to a firm whose alumni helped shape global economic policy, from handwritten promissory notes to algorithmic trading systems moving billions in fractions of a second, from merchant trust to global capital networks. Goldman Sachs has been praised as a steward of economic growth. It has been criticized as a symbol of inequality and opaque influence. Both views contain truth. Both views are incomplete. Because the legacy of Goldman Sachs is not static. It evolves as the world evolves. And its influence endures not because of dominance, but because of adaptability. In the end, Goldman Sachs reflects something deeper about us. Our belief that progress requires risk, that ambition can be both creative and destructive, that power, once accumulated, must be constantly examined, and that the systems we build, financial, political, social, shape our world in ways we often do not see until the consequences arrive. Closing narration. Goldman Sachs is not simply a firm, it is an idea. An idea about how money moves, how value is defined, how power circulates in the modern world. It is neither hero nor villain. It is a mirror, reflecting the forces that built our global economy, innovation, risk, trust, ambition, and the enduring human pursuit of influence. The question is not whether Goldman Sachs shaped the world. The question is whether we understand the world it helped shape, and what we choose to do with that understanding next.